Hey, good morning traders. So today I want to talk about something that is really important, but most new traders and even experienced traders still have trouble with. And this is order size. So welcome to the video where size does matter and the complete order size guide. So in trading, size does matter. Get your head out of the gutter. We're talking about trading here, not what you think. But not in the way that most people think, of course. So it's not about betting big, it's about sizing smart. So everybody thinks that once they grow and once they know how they should trade, they have a solid trading plan that gives them a solid return, they start to size up. So sizing up is good, but betting big is not that good. And if you don't get this right, then you'll blow your account, even with a solid trading strategy. So why order size is everything. Order size controls your risk, your stress, and your survival rate. It's not just how many contracts you enter with, but you should ask yourself, how much are you risking per trade? Risk management is one of the most important things here, guys. So risk management is what separates the profitable traders from the non-profitable traders. How far is your stop? And what size keeps you in the game over 100 plus trades? Think about this. Don't just think about your trade that you're planning in for now. No, think about what size keeps you in this game for 50, 100, 200 trades. Think about this journal and you will see which size is best for you. So stick to the golden rule. Risk 0.5% to 1% per trade. Max. Don't go YOLOing in. I know we've all been there. If you have a trade that goes against you, you want to make all that money back, but it's not a good strategy, really. It's when people go on tilt. It's when people blow accounts, lose accounts, even live accounts. So just don't do it. Do 0.5% to 1% maximum. Then we have minis versus micro contracts. This is really important. When I started trading, I just flew into the minis and never looked at the micros because I thought I was too good for it, honestly. But micros can be very helpful, especially in the beginning. So if you're trading futures, your contract type is your gear stick. The mini S&P 500 is $12.50 per tick. Not per point, per tick. So every time you see price move, one tick, that's $12.50. If you go to the micros, of course, it's 10 times less, so it's only $1.25. You make less, but you lose less. So if you're just new and still practicing, practice with the micros. It doesn't matter. You don't need to get funded right away. If you blow your account, where will you be? So just do the micros. Do yourself a favor. Micros give you flexibility. Smaller accounts, use micros to size down and stay disciplined. Want to build screen time without blowing up? Micros are your sandbox. You can paper trade, but the problem with paper trading is you know that there's no money on the line. If there's money on the line, you will be more diligent. So start with micros and you will never blow up. If you do one micro and 10 ticks go against you, okay, you lost $12.50. But if you do it with the minis, you lost $1,250. So, no, sorry, $125. My math is a little off here. So, too many new traders jump into the minis with absolutely no sizing plan and they blow up fast. So, for your reference, let's go over these. These are some of the tick size for the different instruments in the futures market. So the S&P 500, the tick size is 0.25. So we all know this 4 ticks is a point, and 1 tick value is $12.50. So 1 point, $12.50 times 4, $50. If it goes 1 point above or below where your entry is, let's say you go 1 point below, you're $50 in the hole. So in the beginning, this can be quite a mind shift to get over. If you're trading micros, you will only be $5 in the hole. So big mental shift. So just to illustrate that every asset in the futures market does have a different value, the S&P 500 has a tick value of $12.50, where the Nasdaq, the NQ, only has a tick value of $5. So 1 point is $20 instead of $50. So if you go to the micros, 1 point, of course, divided by 10, $2 instead of $5 on the ES. If you're trading gold or you want to trade gold, there the tick value is $10. So a nice round number, 1 point, of course, $100. So if you go to the micros, 1 point, $10. And if you do crude oil, well, 1 point there, the tick value is $10. So 1 point there, $1,000. 1K. 1K, think about that. So if you want to trade crude oil, think about if you are in drawdown for 1 point, it's $1,000 in the hole. If you go to the micros, it's $100, which I still think is way too much. So if you can, the best instrument in tick value is the NQ, but the NQ is really volatile. So what do you prefer? If you prefer an asset that is very volatile and can go 100 ticks in a minute, Nasdaq is your go-to. I personally trade gold a lot because it has the best of both worlds. I don't trade crude oil that much, but yeah, it's up to you. So this was just as an example for you to show what each asset has, and I wasn't aware in the beginning that every asset has a different tick value. So when I started trading, I went from this to that, and I saw my P&L all over the place. I saw I was in drawdown, and it had a different monetary value than what I was in drawdown an hour before on like the ES. It was really frustrating. So I wish somebody would have told me this in the beginning. But so scaling with precision. Once that you're profitable, here's how you grow. Keep the same risk, but not the same contract count, of course. Keep the same risk. If you are always trading a 2-to-1 risk ratio, keep that same risk, but just go up in contract size. If you are comfortable at the micros, trading 10 to 20 micros, you can trade 1 to 2 contracts. The monetary value will be the same, and the psychology will be the same. The only thing you need to keep into account is you can't, if you go from 10 micros to 1 mini, the 1 mini, you can't divide that anymore. So you can't set 3 take profits anymore, where you did before, because with one contract, that's it. One contract is one contract, you can't divide that. So if your take profits will be your entire position. So keep that in mind. So increase the size only where you can handle your losses emotionally. This is very important. We are all traders, we're all humans. Our emotions get the better of us, but we really need to handle our losses. Losses are just part of the game. Remember that there is no trader that has 100% win rate. There is no trader that wins them all. So you will have losing days. You will have losing streaks. You just need to deal with that emotionally. And we'll talk about that more in another video. So remember, the bigger your size, the worse your psychology can get, because if you're in drawdown on the micros, 3 micros, okay, maybe you're in drawdown for $20. 3 minis, you're in drawdown for $1,000, $1,500. So the psychology can really get to you. Just to recap, order size is your edge if you respect it. So mastering it is what separates the consistent from the clueless, because in trading, size does matter, guys. Size does matter, and smart size always wins. So stay safe in the charts and trade well. I will see you in the next video. Bye.